we start first now with modified duration, then modified duration is calculated as follows. So modified duration equals the Macaulay duration. So Macaulay duration, and we have to divide the Macaulay duration by 1 plus the yield to maturity, and the yield to maturity is then divided by the number of coupons per year. Now mathematically, the Macaulay duration is determined as follows. The Macaulay duration is the present value of the time-weighted cash flows divided by the price of the bond. So if you look at the Macaulay duration is the present value from t equals 1 to the large letter of t. The large letter of t stands for the maturity of the bond. The sum of the time-weighted cash flows. The cash flows of a bond consists of the coupon payments and the par value at maturity, discounted back with the yield to maturity. And that's divided then by the price of the bond, and the price of the bond, that's the present value of the cash flows. And that's the Macaulay duration. You see now, if we calculate the Macaulay duration, then we have cash flows over cash flows, that cancels out. We have 1 plus the yield to maturity to the power of t, cancels out, and we are left then with a time figure here. So the Macaulay duration can be interpreted as the time it takes on average to receive the cash flows out of a bond investment. So that's how we can interpret then the modified duration. The modified duration can be visualized as follows, and that helps perhaps for the understanding of the Macaulay duration. We can take a timeline and we can put now on the timeline the cash flow pattern of a fixed income security. That means that let's take our 3-year coupon paying bond, then we can put on this timeline the coupon payment, the first coupon payment, then we can put on the timeline the second coupon payment, and then finally we can put on the timeline the third coupon payment and the face value at maturity. Now the Macaulay duration can be visualized as follows. The Macaulay duration is the average time it takes to receive the cash flows out of a bond investment. And that can be visualized as follows. So that's the point where we can balance out this cash flow pattern. At this point, we have the Macaulay duration. So at this point where we can balance out the cash flow pattern of a fixed income security, at this point then we have the Macaulay duration. The Macaulay duration helps us now to understand about the price volatility of a bond. That means the higher the Macaulay, or the longer the Macaulay duration, the higher is the modified duration, and the higher modified duration means now, if interest rates change, that the price change would become higher. And that means the price volatility would be higher than of the fixed income security. So that means now, if you are able to determine what are the characteristics that lead to a change in the Macaulay duration, then we know about what will happen with the modified duration and whether the price volatility will go up or go down for our fixed income security. Let's start our analysis. Let's compare this 3-year coupon paying bond with a 10-year coupon paying bond. Then in order to balance out the cash flow pattern of a 10-year bond, we have to move out more to the right here, so we have a longer Macaulay duration. That means we have a higher modified duration, and we will have therefore a higher price change of our fixed income security if interest rates change. So that means a higher price volatility. Therefore we can conclude the following. The longer the maturity of the bond, so the longer the maturity of a bond, the higher duration, respectively price volatility. So that's the first price volatility characteristic for an option-free bond. Then next we can compare two bonds, one bond with a low coupon and the second bond with a higher coupon. So if we include that here, so both bonds have the same maturity, but one bond has a higher coupon. If this is the case, then the bond with the higher coupon would have a lower or a shorter Macaulay duration. Because in order to balance out the cash flow pattern of a bond with a higher coupon, we have to shorten the Macaulay duration. It means you have to move to the left in order to be able to balance out this cash flow pattern. So that means that we would come up with a shorter Macaulay duration that results in a lower modified duration and a lower price volatility. So that means the higher the coupon, second characteristic of price volatility of an option-free bond, the higher the coupon. So the higher the coupon of a bond, the lower duration, respectively price volatility. That's then the second characteristic of price volatility for an option-free bond. Then the third characteristic is now, if we compare a zero coupon bond with a coupon paying bond, and both have the same maturity. So let's take a maturity of 3 years. Then with a zero coupon bond, we would only have one cash flow, that is the face value of the bond, and to balance out the cash flow pattern of a zero coupon bond, we have to move to the maturity of the zero coupon bond, and that means now that the zero coupon bond has a higher or a longer Macaulay duration compared to a coupon paying bond with the same maturity. That means it has a higher duration, respectively a higher price volatility. So that means that a zero coupon bond compared to a coupon paying bond has a higher duration respectively price volatility. It is clear that both bonds then, the coupon paying bond as well as a zero coupon bond, must have the same maturity. If this is the case, then the zero coupon bond will have a higher duration, respectively a higher price volatility. Then there is also a fourth characteristic of price volatility, which I cannot visualize with the cash flow pattern that we have balanced out here using this timeline, which is then the following: the lower the yield to maturity, the higher would be the duration, respectively the price volatility of a bond. Let's move on now to the duration. That means I show you now how duration is mathematically calculated. Duration can be determined mathematically as follows, taking the first partial derivative of the bond price with respect to a change in the level of interest rates, and then we have to divide that by the price of the bond. That gives then the modified duration. To keep now the calculation simple of the first partial derivative, let's take now a zero coupon bond. A zero coupon bond has only one cash flow, and that's the par value paid at maturity. So therefore the price of the bond equals the face value. Take for the face value F divided by 1 plus the yield to maturity to the power of t. This equation can also be written as follows. The face value can just simply be multiplied with 1 plus the yield to maturity to the power of minus t. That's the price of the bond. So the price of the bond is then P0. Now we can take the first partial derivative of the bond price with respect to a change in the level of interest rates. Please note now that the change in the level of interest rates is a change in the yield to maturity. Yeah? So therefore, we have the following equation. the face value times 1 plus the yield to maturity to the power of minus t. And now we can take the first partial derivative, assuming that the change in interest rate is the same as the yield to maturity. I mean, we are just looking at interest rate risk in our discussion. So we take the exponent of minus t ahead of the face value, and we deduct from minus t minus 1. The exponent of minus t minus 1 can be rewritten as minus t brackets t minus brackets t plus 1. We can now rearrange this equation, the first partial derivative of the bond price, with respect to a change in the level of interest rates as follows. We have minus t times the face value, so minus the maturity of the bond, times the face value, divided by 1 plus the yield to maturity to the power of t plus 1. And that is the same as minus t divided by 1 plus the yield to maturity times the face value over 1 plus the yield to maturity to the power of t. We have discussed before that the maturity of a zero coupon bond is the Macaulay duration. So therefore t, the maturity of the zero coupon bond, that's the Macaulay duration that we have here. So that's the Macaulay duration. And if we, for a zero coupon bond, it's its stated maturity, because we have with a zero coupon bond, we have only one cash flow. That's the par value which will be paid at maturity. We have to balance out the cash flow at maturity, which is the face value at maturity, and that is then the Macaulay duration. And the Macaulay duration divided by 1 plus the yield to maturity, that's then the modified duration. So that would be then the modified duration. And if we take the face value of the zero coupon bond and we divide it with 1 plus the yield to maturity to the power of t, then that gives us the price of the bond. So that would be the price of the zero coupon bond. That's the face value divided by 1 plus the yield to maturity to the power of t. Now, if I change the sign of the first partial derivative here, if I change now the derivative sign here with the change sign, and obviously I can do that if I assume mathematically that we take a very, 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 very small change in interest rates in order to calculate the first partial derivative, then I can change the derivative sign with the change sign here in order to proceed now with our discussion. If this is the case, then the equation will be as follows. So the change in the bond price divided by the change in interest rates equals minus modified duration. So minus modified duration multiplied then with the price of the bond. I can multiply on both sides of the equation with the change in the level of interest rates, and that gives then the first term of the Taylor approximation function, which is the price change of the fixed income security, equals minus modified duration multiplied with the price of the bond before the change in interest rates times the change in the level of interest rates. That's exactly the first term of the Taylor approximation function. Go back here to show that the first term of the Taylor approximation function, that's here. So minus duration times the price of the bond before the change in the level of interest rates times the change in the level of interest rates. Now we can take this equation and rearrange this equation in accordance to the modified duration. So if we do that, then the modified duration equals, we can divide both sides of the equation with the price of the bond before the change in interest rates times the change in interest rates, and then we can multiply both sides of the equation with minus 1. We can rewrite this equation as follows. That's the change in the bond price divided by the price of the bond before the change in interest rates divided by the change in interest rates, and the change in the bond price divided by the bond price, that's the percentage change. So that's the percentage change of the bond price divided then by the change in the level of interest rates. So for example, if duration is 5 and interest rates increase by 1%, then we expect that the bond price will fall in percentages by 5%. So that's the meaning of modified duration. Modified duration is a sensitivity measure that tells us how much the bond price will change in percentages due to a change in the level of interest rates. And for this reason, modified duration is unitless. It's a sensitivity measure similar to the beta of a stock, which is also a sensitivity measure telling us how much the stock return will change due to a change in market returns.